analyzing market trends become much more clear when using candlestick signals. We've already illustrated a few weeks back where this top resistance level was much more plain to see that it was going to top out again with a hammer, or a hanging man signal, turning into an evening star signal, closing just above the T-line, and then trading below the T-line, starting our downtrend. There was a potential of it supporting right down in this level, which it did not support. However, we can see that the downtrend has remained consistently in a downward direction, staying below the T-line. Last few days, or last couple weeks, we've had a bounce. We had one day where it closed up above the T-line, and then on, what is today? Thursday, Wednesday, they closed it right back down. What is the likely target? Visually, everybody can see this is where the markets may potentially go to. We did a doji today, which means if this opens lower tomorrow, the probabilities are pretty strong they're going to take it down. They're going to move it in the direction of how they open it after a doji. Having that knowledge makes the target of the 200-day moving average that much more viable. Also, if they open it lower, the magnitude of the next day's move is usually the magnitude of the day right before it. That has enough energy to take you all the way down to the 200-day moving average. The NASDAQ makes it a little bit more clear that once they came up above the T-line, they did a kicker signal right back down again, which tells us there's some force to the downside, making the 200-day moving average very viable. This allows us to not get wiggled out of positions. If we are short, we stay short. If we did get wiggled out, we're right back into the short positions, anticipating that this is our target. For commodity traders, seeing the price open positive after closing at the low end of the previous day and start moving up gives us the illusion, or it gives us the alert that they might create a bullish harami that day. Makes for very easy stop losses. If it opens here and starts up, you put your stop right where it opened. But the probabilities are that they're telling us that the selling has stopped and the buying has started. This allows for getting into trades very quickly and easily, and getting out of trades that might be going the other direction. If you were short, getting out of the short positions back into long positions. And candlestick patterns, such as the fry pan bottom, allows you to take advantage of what is occurring in a pattern versus what the general market is doing. As we can see in AWH, Allied World Assurance, starting back up. Over the past few days, VHC performed very nicely, coming out of a fry pan bottom breakout. And ARNA also coming out of a fry pan bottom breakout. Coming out of a fry pan bottom breakout is what is expected, but you'll have noticed all three of these charts were moving positive when the markets have really been moving negative. That's the advantage that we have with candlestick analysis, is that it shows us where the buying pressure is coming into specific patterns and signals versus trying to find things that are going to move merely on the market direction itself. That'll be it. We'll see you in the chat rooms.